Welcome to the show, Rent to Retires. We are here today with myself, Adam Schrader, and we are privileged to have with us Zach Lemaster, CEO and founder of Rent to Retirement. Hey, Zach, how you doing today?
Doing well. Excited to get this thing kicked off, Adam.
Yeah, absolutely. It's an absolute pleasure to be doing this podcast with you. And before we get started into kind of what we do, kind of what we've been doing in real estate with our lives, how we invest, I wanted to go over a little bit about the market in general, because you've been seeing, I'm sure, like I have, housing crashed in 2021, housing booming, so much appreciation, rents are going up, what's going on? And it's just everything you see, it seems like, maybe it's just because of my algorithm and Facebook and Twitter and all of those things. It's like everybody's talking about housing right now. You can't get away from it, it seems.
Yeah, absolutely. It's an interesting dynamic. Obviously we're all coming from an area, if you were investing, 10 years ago through the 2008 period, where it's like we had this huge market crash, and then we went through this kind of lull through 2008 to 2011, and then things started to appreciate back and kind of go on the upward trend. And then about 5 or 6 years into that, we were constantly hearing, "Oh, are you ready for a bust? Are you ready for the market to correct?" And people have been saying that for now like 7 or 8 years. And housing is just almost in every single market has continued to skyrocket. And then we get hit with this global pandemic, that is just no one knew what to expect and how that's going to affect anything. And if that actually catapulted real estate to perform even better, and on many levels, especially when you talk about the Fed coming in and offering, the lowest interest rates we've ever seen in history, in addition to some government stimulus and different tax benefits and things that people can use to their advantage. So, people are buying real estate right now. Likely, if you have a primary residence or any real estate for that matter, you've appreciated well and have a good amount of equity that you can reinvest. And interest rates are all-time low. People are concerned about the stock market. We've seen some craziness in stocks and different stuff going on, that's quite volatile. And so I think people are kind of resetting where they're at with their investing, what type of asset classes they have confidence in. And people are trying to buy houses and, invest in a physical asset, use a capital and equity that they've built in their portfolio over time, and take advantage of those low interest rates. So it's strange with everything else going on, how well real estate is performed.
Absolutely. And especially, anytime anything goes up in price, you hear people screaming, bubble, bubble, bubble. It's going to burst. It has to burst. It needs to burst. But in reality, when you look at the actual fundamentals in the market, actually what's going on, there's a legitimate reason that home prices are going up, especially in the pandemic, because right now we're experiencing things like we've never experienced before. The simple fact is people want to buy houses and there are no houses for people to buy. And, simple supply and demand tells you prices are going to go up, especially when you're looking in the areas where people really want to live, which right now is not in your city centers. It's more, maybe a 15, 20, 30-minute drive from downtown. That's where people are really wanting to live. And so I wanted to go a little bit into that world real quick. I was looking online and I found this article from the National Association of Home Builders, and it talks about the housing starts in July. They were down because of supply chain shortages and supply chain challenges. And this is something that, based on what we saw with COVID, based on what we're seeing with the Delta variant, based on what we're seeing with Lambda, I think is the next variant coming down, and then who knows what comes after that, and then what comes after that. Supply chain shortages, it seems like there's going to be a disruption here and there for the foreseeable future. And so what happened in July was housing production declined due to rising costs, and overall housing starts decreased 7% to a seasonally adjusted annual rate of 1.53 million units. Now, people may not know, is 1.53 good? Is 1.53 bad? 1.53 is, to put it simply, not enough. I think would you say that's a fair assessment of what 1.53 million means?
Yeah, regardless of the actual statistics and numbers, it's quite obvious that there's a housing shortage, and people cannot keep up with, builders cannot keep up with the demand, and we're seeing that in our own markets with stuff that we're everything we're selling either or renting out is before the construction's even done.
Yeah, and just so people know, 1.53 million is fewer per year than we were building back in the 70s. It's when the population was about 2/3 of what it is today in the United States. So we need significantly more. So you're going to see this. I mean, builder confidence because of these supply chain challenges is down, and when builders don't have confidence, they don't do as many starts. I think I read that there are about 400,000 building permits right now that have been given that haven't broken ground because builders aren't sure about how much it's going to cost to actually build. I mean, you've seen this. I've heard stories and I've experienced it with some builders. They have COVID made them put in escalation clauses in their builds, and so they come to you and say, hey, it's time for us to buy our lumber, time for us to buy all the things we need for to build your property, but we can't afford it now. We need to up your price $10,000, $20,000 to do it. And builders, I mean, sure, they're probably padding their stats a little bit, but the fact is they can't build for the price they used to be able to build at.
Yeah, and I think we are starting to see a little bit of stability in this. I mean, someone could be listening to these statistics and what you're saying, Adam, and think that, oh, well, this is, new construction is not something that I want to be involved in, and could scare them away. And that's not our objective or our point here, because a big part of what we do is new construction. And so it's like, how do you control that? Of course, we're looking at national type stats, and every specific area is going to have a little bit of a, microeconomic analysis. But it's like, what does this mean big picture? And I like to look at the other side of the fence, where when you're looking at these type of numbers, what does that actually mean for the end user, whether it's a retail buyer or renter? And basically what this means is there's a housing shortage, and that, there's not enough homes being provided and being newly built for the demand of the population transition. Perfect example would be some of our Florida markets that we focus on. Florida is extremely booming right now, and there's an extreme housing shortage. They've had and I don't have specific stats for this, but this is what we're currently seeing, is that, there is the homes that are available for sale across the board. And this is pretty much the state as a whole, is the lowest amount of days on market and the least amount of inventory available since they've seen for like 50 plus years. And so there's just this mass amount of people moving to Florida for politics, for cost of living, for the weather, for a lot of the business friendly legislation and things like this. And I think that's an added benefit. You want to look at these statistics and think about, where's the opportunity? And I think something like this there's always opportunity in areas like this.
Yeah. And I will note that I'm still buying that house that had the escalation clause, because even with the $10,000 bump, it still made a great deal of sense whenever it came time to, crunch the numbers and see, because not only did my price go up, but, the rents were going up too. Because I mean, that is another thing that COVID has done for real estate investors, is it's pushed rents significantly higher, more than we've seen. People talk about how home prices have gone up, I think it's 17% nationally, but rents have gone up about, I think, 9 or 10% nationally as well. And the markets that we're in, the markets that are making sense, those are even better. I mean, I've been able to push my rents. I've told all of my property managers, hey, I want to be aggressive when it comes to rent increases. We're having some turnovers. I want to be aggressive. I don't care if it's, maybe vacant for a half month longer, because I know that, with the rent that we're going to be able to get, it's going to set up future rent increases as well. It's not just now. I mean, there's no point in getting in and offering your property for $100 less than it's worth now, because 6 months from now, it's probably going to be $150 less. And then in 12 months, you're going to be $175 or $200 less. And your rent and your tenant is not going to accept a $200 rent increase, most likely. They're going to say goodbye, and you're going to have to, because it's just a different class of renter for the most part in that case. Because, if you have a $1,000 rent, say, or a $1,200 rent, you asking your tenant to go up 16 to 20% in 1 year, you're likely going to be looking for, your next tenant. And that's a little bit pricier than just finding that tenant who pays a little bit more right up front.
And you can have the confidence to do that when you understand the market. And that's exactly what we're talking about today is the type of demand that's available. And yes, rents are increasing. And it's, of course, on an individual basis, it's a balancing act. But over time, I mean, there's a lot of people that get stagnant with their rents. And, we're landlords and we're sometimes too forgiving and too easy. And that's why it's actually a good thing to have a property manager to hold people to what the rules are. There's so many people that just let rents stagnate because, oh, they've been a great tenant, let's keep them in another year. 3 or 4 years go by, and now the rent's at like 70% of what it actually should be, which also affects your potential exit. We buy a lot of houses, the same sort of thing in portfolios where people have just been great landlords, great tenants, and they're significantly below market rent. But just to touch base on another, your previous point about kind of what we're seeing in the market and the escalation clauses, the price increases, it's important for people to realize like the big picture of that. Because yes, over this past year, we've seen prices increase. There's been this extreme lumber shortage and material shortages. And like you mentioned, the supply chain issues that is starting to stabilize and normalize a little bit. And because of that, we've seen price increases. And all people notice is the short term, like, oh, I have to pay an extra $10,000. But to your point, that $10,000 extra or whatever that you potentially could be paying for materials, because that's the builder, what they're having to cover, that also means you're maybe getting, $15,000 to $20,000 of equity in that, or appreciation in that property when it's completed. Like those are actually rising together, the end value as well as the material costs. And usually there's a higher percentage raise on the actual valuation of the house. So it's hard to kind of wrap your head around that when you are just being, dishing out more money on the build, but that's just the dynamics, and that's anywhere. That's pretty much any location that you're building right now. That's the dynamic, but it's supply and demand.
Yeah, I mean, the thing is, you look at it and maybe you're paying an extra $10,000, but so is everybody else in the first place. And number two, you've at least got a property. And with the way things are right now, getting the property can be the trickiest part, just because I know in some places, if you're looking to buy well, not in some places, in a lot of places, if you're looking to buy an existing home, I mean, here in Austin where I live, homes are gone in a weekend with 20 offers for $100,000 over. So just getting that contract sometimes is the biggest asset you can have. And, then you just have to wait. And most of the time, the great part is you wait. And even if it doesn't appreciate that much in the time, rents, like we said, are going up. So by the time you get there and you close and you look for a tenant, suddenly you look down and you say, wow, this rent's higher than I was expecting whenever I first signed the contract. And it's making everything look better number wise whenever you get to the end result. So that's a nice benefit.
Well, let's use a very specific example. I always like to hear about exact, projects that we're working on. And so we'll look at a lot of the new construction that we're doing in Florida. And by the way, to your point, we never want to do new construction or anything that's not going to positively cash flow.
Right.
That way, in reality, the market is kind of irrelevant. If you're going to have a property that is cash flowing well, you can hold it for many, many years. Over time, all real estate appreciates regardless of short-term fluctuations. But as long as you're positive cash flow, I think that adheres to our fundamentals of investing in locations where your rent is going to cover all your expenses in your mortgage and whatnot. So just let real estate do what it does over time. These aren't like spec builds where you have to exit at a certain level, otherwise you're underwater and in a really bad position. That got a lot of people in trouble in the 2008 area. So we're always investing in areas that have positive cash flow. But you also want to look at opportunistic areas where things can appreciate quickly. But to be specific, for instance, in Florida, we have, and this is mainly in the Cape Coral area, we build throughout the entire state in select locations. But in Cape Coral, 6 to 8 months ago, we were building a 4.2. It was all in, including the lot, which lot is usually 20 to 30,000. But total build price was probably in that 240 to 250 range. And just within less than a year, because of material increases, now we're building the same house, that same 1,600 square foot under air 4.2 for I think to the end user right now, to our investors, it's about 275, 280, right in that range. Those houses are right now appreciating, even pre-construction, just based on plans in today's market, between 330 to 340,000, which is a significant amount of equity in today's market. by the time that that house is completed, 8 or 9 months down the road, is likely going to be significantly greater than that, which gives you a lot of exit strategies because you can sell the property for a gain, you can do cash out refi and reinvest some of your money, or just keep the equity in it, which is probably the least strategic thing to do. But cash flow well, and in any one of those scenarios, the house is still positively cash flowing. All those houses are renting out before the construction is even completed because of the demand. I think that like about 1,000 people a day are moving to Florida. It's just insane. But that's an area where you can get into a brand new construction house that's going to have appreciation equity and also adhere to the fundamentals of cash flow. So it's all about the strategy and how you go about it and knowing what your exit plan is or options.
Yeah, I will say I've bought some new construction recently, and getting that email from the property manager before you've seen the certificate of occupancy saying we have an approved renter and a deposit put down is is pretty nice to get, because it cash flow day one. It's a beautiful thing. I mean, I will say the escalation clause that I received, they said, hey, we're going to up your price $10,000, but just so you know, in our next build, if you don't do this, we're going to sell it for $30,000 more than you're paying for it right now. And so that $10,000 has looked pretty good, especially when you figure, even if they're raising it $10,000 or $20,000, you're getting a 30-year fixed rate mortgage. It ups your monthly payment by like $10 or something like that. Like it's
Mm-hmm.
yeah, it's almost laughable when you look at that compared to the returns you would be losing by not continuing the deal or not getting the deal in the first place. So, all right, let's go back to the next article. We've been talking about how there is a shortage, and one of the things that people might want to know is, well, how bad a shortage is it? So, Freddie Mac put out an article a couple weeks ago. They talked about housing supply, a growing deficit in the country. And they estimate as of the end of last year, the US had a housing supply deficit of 3.8 million units. These 3.8 million units are needed to not only meet the demand from the growing number of households, but also to maintain a target vacancy rate of 13%, which is pretty high to me. But it says between 2018 and 2020, the housing stock deficit increased by approximately 52%. And that was when we were actually building homes. Relatively speaking, we had that pause during COVID at the very beginning where housing starts on an annualized basis got down below, I think, 900,000 or so. And so that 3.8 million, I wouldn't be surprised if, next year, whenever we see it at the end of 2021, if it's, closer to 4.3 or 4.4. I mean, we've got people say, housing crash 2021, but when you see these kind of numbers, it really asks, 2025, 2030, kind of when is it going to change? I mean, that's what I look at is it's not just what you're seeing in the market today. Something has to change for there to be a housing burst. I mean, in 2006, 2008, we saw that with the subprime mortgage crisis when you had all the bad loans packaged together because lenders were just lending to, hey, Zach, you can blink your eyes. Here's your mortgage, and then we're going to package it 5 times and send it off to all of these people. That's not happening right now. I mean, lending is still solid. You have a lack of building. You have good, solid loans. So where is the crash going to come from? Do you see anything out there that's hinting to you that other than increased prices, that there's a problem in the market?
I think when I'm looking at what is realistic without being, looking at too many statistics, just breaking real estate down on a kind of national basis, I think in certain areas where it's extremely expensive, there is going to be an affordability threshold for people. Yep. And so that's in a very specific asset class. That's a niche of real estate. And I'm talking about your California market, your New York, Washington, Oregon. I mean, some of these coastal areas where the average, 1950 3.2 is $2 million. And even though, I mean, again, it's supply and demand. So as long as people can afford those, then they're going to keep appreciating. But at some point, you're going to have less people that can afford those higher end type of housing options for their primary residence. That's the only thing that is really concerning to me, to be quite honest. People were very concerned about eviction moratoriums on the landlord space. Realistically, that hasn't really meant much. You can still evict people if they're violating their lease, which most people that are not paying are, and people were concerned about that. And there's a lot of things to consider, but that's the only thing that seems somewhat concerning to me. We're still, the last big crash in real estate was still the Great Recession for real estate in 2008, and everyone wants to compare real estate as if the next anticipated crash were to reflect that and be comparable to that. Well, they're likely, in my opinion, will never be anything that's comparable to that, because the situation is just completely different. Like you mentioned, there were all sorts of people that were not should not have been approved for loans being approved for variable interest rates, these crazy type of loans, that had balloon periods, and not buying, they're buying for appreciation, not really adhering to the investment fundamentals. And I think that at some point, sure, we could have a softening in the market. I don't foresee that happening anytime in the near 5 to 6 years, but who knows? But it could be less of like a national correction. There could be microeconomic corrections in different areas. To me, I don't ever try to time the market. I've worked with, and in our network, we have extremely successful real estate investors that have been doing this for many, many years. Many of them are my mentors, even, that I've learned from over many years. No one has ever told me, Zach, I time the market perfectly. Yes, there's been good times and better times, but everyone consistently buys real estate and has some sort of criteria and fundamentals. And I think that's really the takeaway here is we're talking about the market and what's happening in the market. In my opinion, the market is really irrelevant, because if you have fundamentals that you're investing for, cash flow, and you know how to find the opportunity in any sort of market and continually buy over time and own real estate, because time can expedite your growth, and it's all about buying real estate and holding it over years and letting real estate do what it does, you're going to be a successful investor. But so many people hear about the market and take a pause on their investing because they're thinking, when is this impending crash coming up? In the Midwest and the Southeast, which is mainly the areas we focus on, they don't see these huge fluctuations in market cycles. They're more slow and steady. They appreciate, yes, some years maybe less than others, but you're investing for fundamentals. So before I get off or you better stop me before I rant on too much longer about that.
Yeah, and I think it is important we talk about that, because those markets, the ones that we're looking at investing in, the ones in the Midwest and the Southeast, like you were saying, those ones, when you look at those and what could actually happen and what would have to happen in those markets before your investments didn't make sense, before they would be hurt on day one. It would take a 20 to 25% rent decrease before you're even like break even cash flow. It would take a whole lot to hurt it. You could have in Indianapolis, your property value could go down 10%, your rents could go down 10%. Then that would be a big thing to happen, but it could go down 10% both ways and you'd be fine. You wouldn't be cash flowing as much, but you'd be fine. If you're in California or in New York or somewhere like that, if your rent goes down 10%, if your property value goes down 10%, you're underwater, hoping that there's a oxygen tank somewhere around that you can grab hold of and try to survive through it. Because it's just the idea. There are so many actual real estate markets in the United States. You can break it down like kind of suburb by suburb almost, or even smaller than that, depending on your zoning regulations in the city that you're in. That it is so individualized. But people in general hear about this now national housing thing, which is why I wanted to go over it today, because they talk about it like it's one big thing and how the national housing has to crash. Well, it doesn't. It can go on a long time. I always tell people, you invest based on your fundamentals, and until your fundamentals change, your strategy shouldn't. If you have a sound strategy based on fundamentals, if the fundamentals aren't changing, which there is no sign that fundamentals are going to be changing anytime soon, why would you change your strategy? Why would you put your buying on hold because you've heard, oh, California might crash because it's getting expensive? Does that that doesn't impact my strategy halfway across the country. I'm not going to stop buying in, Florida or Indianapolis or Ohio or somewhere like that because I'm concerned about New York and California real estate prices. If those places crash, the worst that's going to happen is maybe mine goes down a little bit. But on the other hand, maybe Californians and New Yorkers flee to my cities. And then I've got
That's
more.
already happening, right?
Yeah. Yeah. Florida would like to thank New York for all their recent appreciation, I think, in that regard. So, Zach, before we wrap up, I want to talk a little bit about your investment journey. What have you done in your investment journey? Where did you start, and where are you now, and kind of what's your investment goal strategy that you have going on?
Is a dynamic process always, right? Because just we like to put our money where our mouth is and do the exact same thing. Always be buying real estate, and always be growing, because that's how you're, going to be gaining additional knowledge and experience to allow you to be more successful and grow your net worth over time. And mainly, take advantage of the tax benefits of real estate. At this point in our investing, and this is personally, with my wife and I, we mainly buy real estate from a tax perspective. We do cost segregation studies and 1031s on everything, because otherwise we'd have large tax implications. But going back in time to where we started. So, I have a background in healthcare. My wife and I are both optometrists by education. We met in optometry school in Oregon. Got married shortly after we graduated. I was on scholarship with the Air Force, so I spent 7 years in the Air Force as an optometrist. And she worked in private practice. After I exited my time in the Air Force, then we owned some private practices and focused on that area. And man, that was a lot of work. But throughout that entire time, no matter where we were at, we always had an interest in real estate investing. My father-in-law, Diana's dad is a basically refugee from Vietnam that came to Canada and started later in life investing in real estate and ended up growing this reasonable empire, from nothing. He couldn't even speak English when he was here. So that's very motivating to see. But basically he was just telling us, he didn't really tell us anything to do besides just buy real estate, go invest in real estate, blah, blah. and that was it. But we were always interested in investing in real estate. And so throughout our other career paths, we were always buying real estate. And the first house I bought was a duplex, lived in half, rented out the other half, then held that for many years and put some work into it. I think we had like a $60,000 gain in 3 years from that property, and then sold it. Didn't have to pay capital gains because we lived in it for 2 out of the past 5 years, bought more rentals. Anyways, to kind of fast forward, we were continually investing in our local market. We built a flipping and a wholesaling business. I owned a property management business. At some point, we had our hands in a lot. But really what catapulted our investing to the next level was when we started to strategically invest out of state. And we built this kind of idea and criteria in terms of what is going to allow us to expedite our goals, to add some diversity to our portfolio, and really be opportunistic minded of where are the locations that we're going to see the best returns, have the best appreciation. And that takes a lot of work. A lot of our investors that work with us do that specifically because they are limited in investing in their local area, or it doesn't make sense, it doesn't cash flow, or they want to diversify and scale their portfolio, whatever the case is. And that's exactly what we've done. That's where this business was built, is a simple fact. At some point, we replaced our active income as doctors in passive income properties, and that allowed us to stop working and retire from that career field. We still work in a volunteer setting, of course, but it was all because we started to strategically invest in different areas throughout the country. We went in and built our teams to find, acquire, rehab, and manage these properties that other investors can basically just join in and do exactly what we're doing. And we already have the path built for them. That was simply started because a lot of our friends and family and colleagues, a lot of our optometry colleagues were like, you guys stopped working, what did you do? You do this, you're investing in real estate. That's great. They were interested and they wanted to learn it, but they don't have the time and experience. And so, that's kind of what motivated this business in the very beginning, is to assist those people. And so fast forward to today, kind of where we're at, and this is over the course of probably the past 10 to 13 years, roughly, from when we kind of started on this path. But we're buying a lot today. We work in single family, small multi, commercial, office, and retail. We have commercial multifamily. We do new build and development projects, both as a business available to our investor clients and on a personal level. So just over this past year, we acquired it was four. We're under contract now, and we've already closed on 3 retail strip centers. This is out here in Colorado. I mean, these are low cap rates. These are like 5.5 caps, you know. But the whole reason we're doing that is from a cost segregation study perspective to decrease. And you can do cost segregations, by the way, on single family. This isn't a way to take accelerated depreciation to reduce your immediate taxable income, because taxes are always going to be the highest expense that we're all going to pay over time. But we're still doing the same thing our investors are. We're finding out opportunistic markets. We're buying properties. We're doing a lot of new build and new construction, which is kind of what we're bullish on right now, specifically in the Florida market. Yeah, and we're loving it. I'm super passionate about real estate. I will always work in real estate, you know, and it's been an amazing journey and an amazing opportunity for me and my family and what it's provided for us.
That's great. Yeah, I'm one of the first generation real estate investors. I never, if you went back in time and told 20-year-old Adam that, he and his wife would have, 9 rentals and be looking to buy more, I would have laughed at you at the time, because that just wasn't the only thing I've seen real estate investing wise. Was my grandfather and grandmother did the whole, like, move homes but don't sell the home and then rent it out, and it's 8 blocks away type investing. And I didn't even really know how to real estate invest. And then back just before the Great Recession, I started learning about real estate. Thought it was really interesting, but did the whole paralysis of analysis thing for, I don't know, 10 years, and then finally jumped in. And I will warn people, it's addictive. We waited along and then looked at our kind of retirement plan and said, you know what, waiting on the stock market to do good things is not working out as well as we hoped. Why don't we try something different? And the thing we decided to try different was real estate. And we tiptoed into our first one. And then I think 4 months later, we got into contract with our second one. Within another 6 months, we had a third one under contract. And now we went from buying the rehab. Now in today's market, we're buying new construction. We haven't gone into Florida. We're in Georgia for the new construction we're currently building. But it's been quite the journey. It's nice. It's good to look at my spreadsheets every month and see the income come in, and know that number one, I like to call it, as we're buying it, it's a win-win-win situation. The seller wins, we win for buying and getting the money, and the tenant wins because we give them a good property they couldn't have lived in otherwise. So it's not a zero-sum game, which is the great part. I mean, yes, there's a zero sum when it comes to properties, although with new construction that sum keeps getting higher. But really, you want to look at it as you're benefiting. Everybody in the transaction should win. And thankfully in real estate, it's one where everybody can win in the transaction, and then in the future you win even more with appreciation, and hopefully you sell to somebody who wins either as an investor or as a homeowner, which is a great exit strategy in the future whenever you want a 1031 exchange, or if you're CPA and you decide outright sell and reduce your portfolio. So yeah, Zach, is there anything else you want to go over today?
I mean, just to cover that, your last point, I love that you talked about everyone winning, because that's usually not the case in business. Actually, there's, where someone's winning, someone is losing, but there's absolutely an area where you can make it make sense for everyone, right? Because a seller needs to exit the property for whatever reason and sell at their point, but maybe a buyer is looking for a viable rental property that can produce a certain level of cash flow and add to their portfolio and their strategy. And yes, the tenant wins because you're providing a service. And a lot of people overlook that. Sometimes real estate can be a little bit more involved than just, buying stocks and forgetting about it. But you're a contributing member to society. You are housing people and providing a necessity. That's one of the essentials of life, is to have shelter. And I mean, you should be proud that you're providing that to people. we don't always have great tenants and we don't always see eye to eye. But that's the case, that's just part of the game. But that's a very valuable thing. I feel good at night knowing that I'm providing service to people and contributing to the economy, to benefit people's lives and things like that as a whole. And that's a huge benefit. We don't do any other stock investing. I'll try to get on my random 401ks and things like this, but we know real estate has been a proven path. It's probably one of the oldest, if not the oldest, investment strategy that since houses have been around, right? There's always been owners and landlords and tenants. But we don't do any stock investing. We don't do anything else. Frankly, I don't know it. I don't understand it. It's too confusing. It's not exciting to me. And I don't like 401ks because I don't like someone telling me when I can take my money out, when I can use it, and how much taxes I'm going to pay. I just don't like being told what to do, Adam. But I think that's the benefit of real estate is to be able to have that control. And you can create a lifestyle and the benefits. You just have to take action. It's not easy. There's going to be obstacles, but I think real estate is, regardless of the market, there's always opportunity. Actually, don't even think about the market sometimes. Build a criteria, your fundamentals, go out there and get started, and always be buying property. And I think if I had to sum up advice for anyone listening to this that's interested or just beginning in real estate and you want to take it to the next level, just get out there and take action, build a strategy, go buy more property.
Yeah, and everybody out there, go to renttoretirement.com, check us out. You'll see you can schedule a free consultation with some of the team members to go over kind of how you can build your investment strategy, what properties you can even look at to build your portfolio. Reach out to us there. You can also check us out on Facebook and YouTube. It's facebook.com/renttoretirement. YouTube, we have a great YouTube channel that's growing daily. We're putting videos up there all the time. So check us out. If you have any questions or comments you want to send us, send it to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Also, please go out and give us a review on whatever podcast platform you listen to. We'd really appreciate it. It would go a long way. And until next time, we'll see you around.